On this morning's Ag Issues program, as always, a pleasure to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thank you.
Well, as always, appreciate it, and we got a lot to discuss. And one of the things we want to talk about or focus on today, and this is involving prepaid farm expenses, which, you get to the end of the year, a lot is talking about prepaying input expenses by the end of the current year, but there are also obviously some tax rules involved in that. But we want to set this up by looking at what we're seeing currently as far as the economic conditions are concerned, because input costs are such a big factor right now, too.
Well, that's right. We've got inflation in the economy, and of course that affects the farm economy also, and we see that substantially on the input side. So when we're talking about seed, feed, fertilizer, and chemicals for next year, of course, that enhances the already existing incentive to go ahead and buy the inputs now to lock in your price. And so it's possible that we could see more prepaying and deducting this year than next year. And the question really is, I think, twofold. One is that the best tax strategy? And this is indeed one of those strategies we can look at late in the year, where we've got a pretty good fix on where we're going to come in at for a farm client at this time of the year. We're doing projections on income tax for this year as well as next year. Should we go ahead and move those expenditures that are going to have to be paid to put in next spring's crop into this tax year, or is it better to just pay and deduct in the year that they're purchased, which would be next year for next year's crop? So that's the first aspect of this. And the second aspect of this, not only from the tax side, is the broader economic picture, and that's what you hinted at. And I think that's also tied into another problem with this, and that is there are very specific rules that have to be followed to properly prepay and deduct if you're going to try to do that in the current year. If you're going to prepay next year's expenses this year and get the deduction this year, there are a number of rules that have to be satisfied to make sure that is done perfectly to avoid an IRS challenge on it, because this involves the issue of cash accounting. And farmers on the cash method of accounting can prepay and deduct in the current year for next year's expenses if they do it right. But this has been an audit issue with IRS, and there have been, over the past 7 or 8 years, several very prominent ag cases. A huge one out in California a number of years ago, where IRS has picked at the corners, if not a complete frontal assault on prepaying and deducting expenses. So farmers that do this, and I know a lot are getting ready to write that check this fall, I think it's a good time to review what those rules are to make sure it's done correctly.
In many aspects, it's kind of looking at 3 different conditions, or at least a ruling that the IRS has that basically they need to look at 3 separate conditions on that will really have to be satisfied for the prepaid expenses?
Yeah, there needs to be a binding contract. You have to have a business purpose, and you can't materially distort income. Now, the first condition on having a binding contract, this is very important. There's a lot of sloppiness that is done by farmers when they try to prepay and deduct. You have to have an actual purchase evidenced by a binding contract for specific goods of a minimum quantity that are actually deductible items that you will use in your farming business over the next year. If you don't have specific quantities or you've got a right to a refund of any unapplied credit, that indicates that what you've done is just plunk down a deposit, and you're not going to get a deduction for that. Or if you retain the right to substitute other goods or services for those that are indicated in the purchase contract, that's also a deposit. Now, one of the famous cases on this, it's pretty simple, but unfortunately we see this more often than we should, was back in 1982, you had a farmer goes to his local elevator near year's end, writes out a check for $25,000, and he tells the elevator operator that he's going to be back sometime in January to pick up $25,000 worth of supplies. He then deducted that $25,000 for the current tax year, and the IRS challenged that, and he lost. He lost that case because that's what a deposit is. And I just wonder how many farmers are sloppy in doing that kind of stuff. That should not happen. And so the IRS looks at that. That's an easy one for them. When you do it that way, that's easy for them to pick off. And they think that how the seller of the inputs also characterizes the transaction on its books matters. But I think that's kind of immaterial to the characterization of the transaction for the farmer's tax purposes. But I'll just throw that out there because I've seen IRS look at that in certain situations. So if you enter into this first condition, if you enter into a written contract to buy specific goods that are otherwise deductible in your farming business, and you're going to use them within the next 12 months, and the payment does not exceed in total the price and quantity established in the contract, then you've satisfied that first condition.
Well, in the business purpose one, is that the case where, whether those pre-purchase items were a business purpose, or do some do that just strictly to avoid the tax purpose?
Well, Greg, we do a lot of things just kind of to avoid tax consequences, but I can tell you this one's easy, and the IRS doesn't really look at this test at all. I think if you give a farmer about 8 seconds, they can come up with a business purpose for anything that they do, and that's why IRS just doesn't challenge it. So, yeah, you do have to have a business purpose. It's not to be entered into solely for tax avoidance purposes, but obviously one of the major reasons to do this is to avoid tax. But just make sure that if you ever get challenged on it, you have thought through what your business purpose is. And that's pretty easy. I'm locking in a price. I'm locking in a supply. That's really easy. And there's no challenge on the second requirement here.
And then one that is interesting from the reading I've had is the material distortion of income. And I guess maybe, is there a defined explanation or, I guess, definition of what that is?
No, there's no bright line on this one. And, of course, when you pre-purchase and deduct, what you are doing is you're distorting your income and your expenses, and you're doing that deliberately. But what the IRS looks at is whether there's a material distortion of income, and they seem to get most bent out of shape when they see a farmer's pattern of pre-purchases over time moving in tandem to income. So if there's that suspicious tandem relationship between the amount of your pre-purchases and deductions and the amount of your income, in other words, your income's high for 1 year, so your pre-purchases go up. Income drops the next year, your pre-purchases go down. And they see that marching lockstep over a period of time, then they might raise an issue with respect to that. But again, this is this is not looked at. This subtest is not looked at nearly as much as the binding contract issue. The binding contract issue is an easy one for IRS to pick apart. It's also easy for farmers to do it right. So make sure you get that written binding contract for the purchase of specific goods that are deductible in your farming operation. You're going to use them over the next 12 months, and you're going to be fine.
I would assume, Roger, that there is some type of overall limitation on the amount of deduction you can do for prepaid expenses?
Yeah, there is. It's 50% of your total deductible farming expenses, not counting the prepaid. So what you do is you count up what all your total deductible farming expenses are, and then you can prepay and deduct up to 1/2 of that. And that's largely drawn right off the Schedule F, including your current year depreciation expense.
Now, like several other things in life, are there exceptions to that?
Oh, of course there are. Life would be too easy if we didn't have exceptions to these rules, and my seminars would be shorter than they are. But there are exceptions to that 50% test. One big one is when you have a change in business operations caused by extraordinary circumstances. Then you can blow past the 50% requirement there. And what the IRS has said in the past is if you've got, for farmers, a major change in federal farm programs, let's say we've got a 1983 style payment in kind program that idled out of land, or you've got a 96 farm bill program that really changes the Freedom to Farm program that really changes the structure of the farm programs. That can be an extraordinary circumstance. Or if you have, separate from farm programs, separate from what the government does to your farming operation, if you have a big casualty loss or you got a disease outbreak in your livestock herd or something of that nature, that can constitute an extraordinary circumstance that gets you out from the 50% rule. And then there's another test for a qualified farm-related taxpayer. If you meet that definition, I won't get into that, you can meet the 50% test over the last 3 years on an aggregate basis rather than just over the last year.
Now, can this situation on prepaid expense, can that be done on rent as well?
Well, you've got to be engaged in the farming business to be able to be, when you're talking about some of these exceptions here, the qualified farm-related taxpayer, you've got to be engaged in the farming business. Your principal occupation has to be farming. And this is one situation where we can get into issues with respect to cash rent. Because IRS views cash renting as not a farming activity, it's a rental activity. And that permeates a whole bunch of other areas of the tax code, too, where we see that cash renting ground can create problems.
But all of this is something that you are currently discussing, as a matter of fact, on the Kansas State University tax schools, that you've had sessions already and you've got sessions coming up as well.
That's right. We had the first two out west last week. We were in Garden City and Hayes. And by the way, I heard the weather report where it's in the 20s in Elkhart. Last week, Greg, it was 91. I saw that on the pickup once on Tuesday afternoon. 91 degrees going from Garden City to Hayes before that wind came in, which was horrible for a couple of days out there. And by the way, North Platte had 5 inches of snow this morning. So just just north of there's a bunch of snow. So the weather's changed. But yes, we are covering this. And when we talk about prepaids and tax planning, it's part of a broader discussion that we're engaging in with respect to financial distress and what are economic conditions right now in the general economy and how is that affecting farmers, and where are we at on the comparisons back, and whether there are parallels back to the late 1970s. That we can use to compare where we're at right now. And I'll get into more of that this week. We've got an online tax school this week, and then Salina and Lawrence are next week.
Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, is joining us. And Roger, short amount of time, but I want to cover a couple of other things. And this concerns Chapter 12 bankruptcy, and I guess in this case, farm debtors being eligible for Chapter 12 bankruptcy.
Yeah, these are two more Kansas cases, western Kansas, southwestern Kansas, Garden City area on one, and then kind of north, central northwest Kansas, Plainville area up north of Hayes. And the question is, of course, to file Chapter 12 bankruptcy, that is specifically available for farmers and ranchers, someone that's engaged in farming and meets the definition of a family farmer. Well, the question basically in both of these cases is if you pare down your operation sufficiently, you sell off your assets, you might have a creditor that challenges your eligibility for being able to file Chapter 12 when they say, well, you've sold your land, you've sold your livestock, you've sold your equipment. We think that you're not you don't meet the definition of a family farmer anymore. You don't have any farm assets, so you shouldn't be able to file Chapter 12. And that's an important avenue for a farmer to utilize because you can deprioritize taxes in a Chapter 12. There are other favorable provisions in a Chapter 12 for a farmer and rancher that you don't get in, say, a Chapter 13 reorg or a Chapter 11 reorg or a Chapter 7 liquidation. So Chapter 12 is very important. And both of these cases indicate that the test, at least by a bankruptcy judge in Kansas, and I'll tell you, we've got a great bankruptcy judge in Kansas. If you can prove that you still have an intent to farm, he's going to look at the totality of the circumstances, and it's not, you're probably going to win the case. So if he can get you in there and qualify for Chapter 12, you're probably going to make it. And he did that in both of these cases here. Based on the totality of the circumstances, they said in the one case out near Garden City, that the debtors it was a married couple, they had established their intent to continue farming with family help. and that the liquidation of their existing entity and downsizing was part of a shift to a smaller scale farming operation. So under that totality of circumstances test, they remained engaged in farming and they were eligible to file Chapter 12. The other Kansas case, involved an individual that had been in farming for about 40 years. He had 15,000 acres that he farmed, over 1,800 cattle, and 5 employees and more than 20 vehicles. Runs into financial trouble in those rough years, 14, 15, and 16, and started an orderly liquidation of most of his farm assets. Triggers a massive tax bill, over $300,000, federal and state, files Chapter 12 late last year. And a creditor came in again and sought to dismiss it because they said, well, he's abandoned farming. And the court said, no, he hadn't abandoned farming. He had scaled back his farming operations before filing Chapter 12 and still had the means and the intent to continue farming. And the court said, we still own some of these entities here. And they remained active. And so he met the family farmer test. So 2 good cases in Kansas that show us that if you have the intent to continue farming, it's safe to go ahead and downsize your operation substantially to restart on a smaller basis. And that's really what Chapter 12 is all about.
All right. Well, Roger, as always, appreciate it. And by the way, did want to ask if people want more information about attending one of your tax schools or the online one this week, what's the best way they can do that?
Well, 2 ways. They can either contact me directly or the Ag Manager website at K-State, the Department of Ag Econ. So Ag Manager, I don't remember the address off the top of my head, but Ag Manager or just contact me directly and we'll get them more information on how to register.
Okay, sounds good. Roger, as always, appreciate it. Thanks.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.